I just spent 10 days examining 263 dividend stocks across every sector, from tech to pharma, REITs to defense, you name it. My goal wasn't to find quick wins or next quarter performers. I was hunting for something much rarer, true forever stocks. The kind you buy once, tuck away, and still collect growing dividend checks from 15, 20, even 30 years later. The kind that become generational wealth machines. What I discovered floored me. Only 4 stocks, less than 2%, met my strictest safety criteria for genuine long-term wealth building. Stocks that are designed to outlast market crashes, recessions, and whatever else the economy throws at them over decades. These aren't for day traders or quick flippers. These are for people who understand that real wealth comes from owning elite businesses for decades while they compound their money and increase their payouts year after year. I'll first reveal exactly what metrics I use to eliminate 259 stocks, then break down the 4 survivors that could genuinely fund your retirement, create generational wealth, or simply give you that financial peace of mind decades from now. Because when I say buy now and hold forever stocks, that's exactly what I mean. So what exactly makes a dividend stock worthy of buy now and hold forever status? The first criterion is consistent free cash flow growth. Free cash flow is what's left after a company pays for everything it needs to operate and grow. It's the actual cash that can be used to pay your dividends, buy back shares, or reinvest in the business. But having a positive cash flow is not enough. I want to see a clear upward trend over multiple years, a staircase pattern showing they're generating more actual cash year after year. Why? Because without growing cash flow, a dividend is living on borrowed time. You might collect a few nice payments, but eventually reality catches up. The stocks that made my final cut show this beautiful upward trajectory of cash generation that gives us confidence for decades ahead. The second criterion is exceptional free cash flow margins. I'm looking for 20% or higher. If a company makes $100 million in revenue, I want to see at least $20 million of that becoming free cash flow. Why is this so crucial? Because high margins give companies breathing room. When economic storms hit, a company with 30% margins can weather a significant drop in business and still pay your dividends. A company scraping by with 5% margins? One bad quarter, and your dividend is on the chopping block. These high-margin businesses typically have strong competitive advantages, whether it's brand power, intellectual property, or network effects, that allow them to command premium prices or operate more efficiently than competitors. They're not competing on price. They're competing on value, and that translates directly into decades of reliable, growing dividend payments for you. All 4 stocks that made my final cut have FCF margins well above this 20% threshold, some approaching or exceeding 30%. That's the kind of financial fortress you want protecting your dividend income for the next 20-plus years. Third, I demand a sustained dividend growth history of at least 10 consecutive years. Any company can start a dividend when times are good. The real test is whether they keep raising it through recessions, market crashes, and industry disruptions. A decade or more consecutive raises shows management's unwavering commitment to shareholders and their confidence in the business model. These aren't companies that treat dividends as an afterthought. They're built around rewarding shareholders for the long haul. Fourth, I look for adaptability to economic changes. This is crucial for a forever stock because over 20 to 30 years, entire industries can be disrupted. I specifically examine how each company evolved its business model over time, invested in new technologies, and positioned itself for future market shifts. The companies that made my final list have demonstrated they can not just survive, but thrive through changing economic landscapes. They're not stuck in the past. Finally, I wanted these stocks to provide sector diversification, so you're not overly exposed to any single industry. A true forever portfolio needs to be resilient against sector-specific downturns. If healthcare struggles, your technology or real estate holdings can carry the weight. This diversification is built right into my final 4 selections. Now that you know my strictest safety criteria for genuine long-term wealth building, let's examine each of these four dividend powerhouses, starting with a healthcare company that's undergone a remarkable transformation. AbbVie, ticker symbol ABBV. AbbVie is a healthcare company with a massive market cap of $342 billion. This isn't some speculative biotech play. This is a healthcare powerhouse. When I compared AbbVie to other major pharmaceutical dividend payers like Johnson & Johnson and Pfizer, something fascinating emerged. While J&J has been dealing with ongoing litigation issues and Pfizer has struggled with post-COVID revenue declines, AbbVie has quietly outperformed them both, climbing nearly 20% over the past 12 months while still paying a substantial dividend. What makes AbbVie special is how they've handled what could have been a company-killing problem. For years, critics pointed to AbbVie's dangerous reliance on a single drug, Humira, which once accounted for over 70% of their revenue. When a blockbuster drug loses patent protection, it typically spells disaster. But AbbVie's management executed perhaps the best patent cliff navigation I've ever seen. They strategically acquired new companies, developed their pipeline, and launched new blockbusters like Skyrizi and Rinvoq. The result? Humira's patent expiration came and went, and AbbVie barely flinched. This execution shows up clearly in their free cash flow numbers. Last year alone, they generated a staggering $17.8 billion in free cash flow with a margin of 31.7%, well above our 20% threshold. Think about that. For every $1 in revenue, AbbVie keeps nearly 32 cents as free cash. That's financial efficiency that puts most companies to shame. This robust cash generation supports a 3.4% dividend yield, significantly higher than the S&P 500 average. But the yield is only part of the story. Their 5-year dividend growth rate stands at 7.2%, meaning your income stream from AbbVie grows substantially faster than inflation. Better yet, I expect this growth rate to accelerate back above 10% in the coming years as their post-Humira strategy continues to bear fruit. And let's not forget their 11-year streak of consecutive dividend increases. That means they've raised their dividend every single year since being spun off from Abilabs through the COVID pandemic, interest rate hikes, and everything in between. From a valuation standpoint, AbbVie trades at a forward PE of 15.9 times 2025 earnings. This is higher than their 5-year average of 11.3 times. But there's a good reason. Wall Street agrees with my assessment. Analysts rate the stock a strong buy with an average 12-month price target of $219 per share, suggesting nearly 15% upside from current levels. Combine that potential price appreciation with the 3.4% dividend, and you're looking at possible returns approaching 20% in just the next year. For long-term dividend investors, AbbVie represents that rare combination of current income, strong growth potential, and proven adaptability. Exactly what we need in a forever dividend stock. Next up is Broadcom, ticker AVGO, a technology company that's positioned itself at the center of the AI revolution. What impressed me most when comparing Broadcom to other semiconductor dividend payers like Texas Instruments and Qualcomm is its remarkable evolution. While TI has maintained a steady business model and Qualcomm remains heavily tied to mobile, Broadcom has completely reinvented itself. Just look at their transformation. 10 years ago, Broadcom generated $6.8 billion in annual revenue. Today, that figure has exploded to over $54 billion. This isn't just growth. It's a fundamental business transformation. Broadcom saw the AI wave coming years before most investors and positioned itself perfectly. They've also expanded beyond pure semiconductors into software through strategic acquisitions, creating multiple revenue streams that strengthen their overall business. The results speak for themselves. Over the past 12 months, shares are up an impressive 59%, though they've taken a breather year to date, down about 15% as the entire AI sector has cooled off. But make no mistake, this pullback represents opportunity, not a reason for concern. What truly sets Broadcom apart is its dividend history. From 2018 to 2022, this company maintained a yield around 4%, while growing its dividend at a stunning 20% annual rate. Finding that combination, high yield and high growth, is like finding a unicorn in the dividend world. This exceptional dividend growth is powered by consistently increasing free cash flow. Looking at their FCF growth chart, it's like watching a staircase being built upward year after year. Each step represents more cash that can be returned to shareholders. Broadcom maintains a free cash flow margin of around 26%, well above our 20% threshold. This means they convert more than a quarter of every revenue dollar into free cash. Today, Broadcom's yield sits at 1.2%, lower than historical levels, but that's only because the share price has risen so dramatically. Their 5-year dividend growth rate remains robust at 14%, and they've increased their dividend for 14 consecutive years. When I compare this to other tech dividends like Intel, which has struggled to maintain its dividend, or even Apple, whose yield has compressed below 0.5%, Broadcom's combination of growth and shareholder return stands out. Valuation-wise, Broadcom trades at a forward PE of 29 times 2025 earnings, above their 5-year average of 21 times. But like AbbVie, this multiple expansion reflects their business transformation. Faster growth, higher margins, and stronger competitive positioning justify the premium. Analysts rate Broadcom a strong buy with an average 12-month price target of $248, implying a substantial 25% upside from current levels. Before we get to the next two stocks, give this video a thumbs up if you have already found my research valuable. Also, consider subscribing to the channel for more such amazing content. All right, moving to financial sector, we have S&P Global, ticker SPGI, a company that exemplifies consistency in a volatile industry. When I compared S&P Global to other financial information providers like Moody's and FactSet, what stood out was S&P Global's remarkable resilience across economic cycles. While traditional financial companies like banks see their fortunes rise and fall with interest rates and economic conditions, S&P Global has built an information and analytics powerhouse that remains essential regardless of market conditions. With a market cap of $157 billion, S&P Global dominates the credit rating industry alongside a few select peers. This is a business with an incredibly high barrier to entry. You can't simply launch a new credit rating agency and expect the market to take you seriously. This competitive moat creates long-term stability that's perfect for a forever dividend stock. Over the past 12 months, shares are up 20%, and they've held steady year-to-date even as market volatility has increased. What's particularly impressive is how S&P Global remains largely insulated from many factors that worry investors. Take the recent talk of tariffs. For instance, while many companies will be significantly impacted, S&P Global's business model remains largely unaffected. Their free cash flow tells an incredible story. In 2024, their free cash flow exploded by over 300% to a record $5.3 billion. Even more impressive is their free cash flow margin of 38.3%, meaning they convert over 38 cents of every revenue dollar into free cash. This efficiency dwarfs most companies in the financial sector. For comparison, even well-run banks typically operate with single-digit FCF margins. While S&P Global's dividend yield is admittedly modest at just under 1%, its dividend growth story is exceptional. They've maintained a 10% 5-year dividend growth rate, and more remarkably, they've increased their dividend for 51 consecutive years, making them one of just 54 companies on the prestigious Dividend Kings list. Think about what that means. They've raised their dividend to the 1970 stagflation, Black Monday in 1987, the dot-com crash, the 2008 financial crisis, and the COVID pandemic. Many financial companies slashed or eliminated dividends during these periods, but S&P Global kept right on raising theirs. From a valuation perspective, S&P Global trades at a forward PE of 29.5 times 2025 earnings, almost exactly in line with their 5-year average of 29.4 times. Their EV to EBITDA ratio sits at 24.1 times, slightly below their 5-year average of 25.1 times. In other words, despite strong performance, the stock remains reasonably valued relative to its own history. The last stock on our Forever Stocks list is Prologis, ticker PLD, a real estate investment trust that's positioning itself at the intersection of e-commerce, supply chain transformation, and even artificial intelligence. I carefully compared Prologis to other blue-chip REITs like Realty Income and Digital Realty, and what makes Prologis special is its unique combination of stability and innovation. While Realty Income focuses primarily on retail properties and Digital Realty concentrates on data centers, Prologis has built a diversified portfolio of industrial and logistics properties with strategic expansion into high-growth areas like data centers. With a market cap of $96 billion, Prologis ranks among the largest REITs globally, behind only American Tower and Welltower. Over the past 12 months, shares have held steady with a 1% gain, and they're down just 2% year-to-date. Impressive stability in a volatile RIT market that's been pressured by interest rate concerns. What truly sets Prologis apart is its global footprint. It operates on 4 continents with over $200 billion in assets under management. Their tenant list reads like a who's who of corporate America, with Amazon and Home Depot topping the list. I'm particularly excited about their strategic expansion into data centers. With AI development accelerating and cloud computing continuing to grow, data center demand is skyrocketing. While it's still a small piece of their portfolio, Prologis is positioning itself to benefit from this secular trend while maintaining its core industrial real estate expertise. Prologis' financial strength is evident in their consistently growing free cash flow. Over the past 5 years, their funds from operations, the REIT equivalent of free cash flow, have shown steady growth, increasing from $3.31 per share in 2020 to an expected $4.46 in 2025, a clear upward trajectory that supports their dividend growth. Their cash generation efficiency is equally impressive, with FFO margins consistently above 25%, exceeding our 20% threshold by a comfortable margin. This efficiency means they can distribute substantial dividends while still retaining enough capital to fund strategic expansions into high-growth areas like data centers. Prologis, however, delivers both high yield and impressive growth. Their current yield sits at nearly 4%, well above the market average. But what's truly exceptional is their 5-year dividend growth rate of 12%, a figure that would be impressive for any company, let alone a REIT. They've now increased their dividend for 11 consecutive years, demonstrating a clear commitment to growing shareholder returns. From a valuation perspective, Prologis trades at a forward price-to-FFO ratio of 23.1 times, below their 5-year average of 26.9 times. This suggests the stock is currently undervalued relative to its own trading history, a potential opportunity for long-term investors. I've been particularly vocal about Prologis under $100 being an attractive entry point, and the stock has been hovering around this level recently. Analysts seem to agree with my assessment. They rate the stock a moderate buy with an average 12-month price target of $120, implying over 15% upside potential. So there you have it. 4 exceptional dividend stocks that pass my ultra-strict criteria for long-term wealth building: AbbVie in healthcare, Broadcom in technology, S&P Global in financial services, and Prologis in real estate. Each of these companies demonstrates the rare combination of consistent free cash flow growth, exceptional margins, sustained dividend increases, and adaptability to changing conditions, and they collectively provide sector diversification that can help weather any economic storm. Whether you're building a retirement portfolio, saving for a long-term goal, or simply want to own excellent businesses that pay you to hold them, these 4 dividend powerhouses deserve serious consideration. If you found value in this analysis, click that like button to help more people discover these dividend opportunities. Subscribe to the channel for more in-depth stock research, and let me know in the comments which of these 4 forever dividend stocks you find most compelling. Thank you for watching, and I'll see you in the next video.